Afternoon, everyone. Welcome to today's SEM Live with the following title, The Endgame, Why and How. My name is Henrik Zeberg, and I'm joined by Francis Hunt, the market sniper. And as always, we need to go through our disclaimer. Before we begin, please note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and information provided is intended for educational and discussion purposes only. Today's session will last approximately 45 minutes, 30 minutes of discussion, followed by 15 minutes for Q&A. If you'd like to ask a question, please use the space at the top of your screen to send it directly to us. And please note that this talk will be recorded and sent to you directly to your inbox. So, as I said, today I'm joined by somebody who needs little introduction to those who follow macro trends, technical setups, and systemic risk. Francis Hunt, also known as the market sniper. You are
delighted to be with you, Henrik. Thank you.
Yeah, you are a seasoned technician, macro thinker, and educator, and you've been very vocal on the fragility of the global system. And you've been talking about the systemic risk, sovereign debt traps, and what you also call the final unwind of the everything bubble. So this is what we're going to talk about here today. And first of all, welcome, and let's dive into it.
For sure, I'm ready.
What is your big picture here, Francis? What is it that you talk about when you say the unwind of the everything bubble? Please give us some insights on that.
Yeah, so I start every interview, and I'm almost formulaic. It sets the tone if you set the architecture or the grounding for a discussion, and the discussion is essentially a debt-based collapse. There's too much of it. It's costing too much in terms of interest being paid on it, and for a variety of reasons, we're going to face a debt-based collapse. We've reached that point. We masqueraded and managed to engineer a situation that allowed for a 40-year bull market in bonds. We abused that exorbitant privilege of being able to go to a money creation machine. And we've reached the point now where the assets class is no longer being accepted as a good hold for a long-term period going forward. This is known as financial repression. This is typical when interest rates will actually be well below the true inflation, and don't look to government statistics for that. And at the same time, possibly the currency of this particular nation, the hegemon in the United States, you're also going to have losses there on the power of the currency. So when you have an over-indebted nation, I mean, Ray Dalio says this is not rocket science, this is not Francis speaking only, you typically get, they want to try make the rates as low as possible because they can't afford the interest payments thereon, and pass as much of the damage or the devaluation, that's the financial repression bit, they need to devalue a debt that they owe. And that's how they reduce it to being manageable. And that means the dollar currency, as you've already been seen, has been rather weak, and also the debt markets. And I've highlighted that those two things go hand in hand, but they're a little bit like steps. First, when we first made our primary pronouncement, it was our first call on the bond markets, that this is it, it's turned late 2020. We are macro technicians, and there was a blow-off valuation brought about by the events of CV19. And that's typically how rallies, that's how markets end. They blow off, and then they crash, and the dynamic has changed. And we had a simultaneous to that, we had a blow off to the downside, or let me rather say a capitulation in interest rates. So of course the relationship, rates up, bond values down. So since then we've had an increase in rates, and that's squeezing over-indebted citizens. Particularly we're talking United States here, where credit is king on everything. Your credit score is almost your God score. It shouldn't be that way, but it turns out to be that way. People borrow for everything. Many don't even know how much they paid for a car. They just know their payment. And everything is financial terms. This whole system of being able to do that and export T-bills and dollars is coming under challenge, and this is why. So a lot of people get into the weeds about where's the stock market going and a lot of other things. My core answer is the architecture. It's a bit like, the building is collapsing because the foundation is bad and it's tilting over. And the interior designer is talking about the curtains or whether they should be changed or the carpet. You need structural engineers now, not interior designers. This is a systemic-based collapse. And that is at the very foundation. And when you have foundational collapses, the building isn't saved. It collapses. It needs entire demolition. And that's why you're hearing or heard the reset as a word, something we chose in our branding many, many years ago that since then Klaus Schwab and the World Economic Forum and others have started to utilize. And then we symbolized it with my lack of tech literacy. Every time I had a problem, I hit the power button on the computer box and just rebooted. And that is in essence where we are. It's very severe, and we haven't yet experienced the eureka moment that was like Lehman's for 2008 or the lockdowns that followed the events of 2020 in March. So we are awaiting that, and we're in the skidding, starting to fall, but we're going to have more major event risk, I think, materialize in the not too distant future. So that's my opening gambit to your question.
And it's so nice to hear you say all these things, because it's like my inner voice speaking also. So I'm very much on your side on this, and I see definitely the same. But now also playing devil's advocate here. I mean, why is it that we should be so worried? I mean, we have this apparently looking away from today's ADP numbers, but apparently the economy is still strong. That's also what the Fed is telling us. We have a stock market that is moving up, and so aren't we just two old boomers just seeing a risk everywhere? Why is it that when is it going to happen? This is also a question I'm being asked. Why is it that you're so negative on things? Now we don't have the tariffs anymore, situation, or not to the same degree. We don't. I mean, it seems like also things are maybe calming down in the Middle East, or hopefully also, and all these things. I mean, why the Moody sentiment?
Yes, a lot of people think it's just black pill stuff to get clicks, to talk really doomer. I'm inherently not doomer. I'm not a pessimist by design. I just call truth when I believe I have seen it. And in fact, we've been very optimistic before in boom cycles in the run-up to the year 2000 and 2008, which was very much an expansionary phase, both in the internet phase and then the property phase. So I don't just dine out on doing it, but these are macro trends that don't go away and they end up getting cyclically dealt with. You mentioned there's two things: the Fed stats and employment, and you also mentioned the stock market returning and even going a slightly bit beyond previous highs just before the collapse as reasons to be cheerful. And the key aspect with this is, first of all, unemployment is a lagging indicator. So it's the last thing you see. There's already real trouble. Companies don't choose to elect people to lay people off. They'll even switch to the single-ply toilet paper in the public cloakroom before they do that, because it's costly. You have to pay 3 months of wages for someone who's no longer delivering an output, usually some sort of severance, sometimes more depending on duration and seniority in the business. And it's very hard to bring those people back. Some are tied to accounts. Relationships have been built if they have a revenue line attached, like sales forces, for example. So you tend not to want to do it. Things are already pretty dire by the time that happens. In actual case, it's often quite close to being very near to the bottom by the time you get peak unemployment. So that means you've been falling for quite some time. And that's where I think we already are. There's also the aspect about economic numbers. And when you're in a liar's society, expect liars to lie. And in the non-farm payrolls, which, by the way, will be tomorrow, and we do a live trading day on that, because July the 4th, happy birthday to every American out there who's watching this for Friday. We still love you as people. Just because we talk doomer about your economic trajectory is not to say that we want to be mean. But the non-farm payrolls have already 6 months, by the way. We've just tipped into H2. So also happy half year for everybody else as well. They've already removed 213,000 jobs that they have claimed to have added during the process of adding non-farm payrolls each first Friday of every month. So within 6 months, it's already got a restate down. Now, last year, at the end of the entire year, you had over 819,000. So the notion of accurate statistics is one that should be 100% challenged. The notion of the birth-death model and assumptions that add jobs in every time a limited company is formed. I form limited companies all the time. They're often just special purpose vehicles. I don't hire staff, I don't hire a secretary, and I don't buy office space. I already have all of that. And it's you can't go with the assumptions, and you can't trust the stats unless you believe your current inflation rate is that which the BLS gives you. So I would say, the whole game is based on deception. There is legalized deception with assumptions and, not comparing a basket of goods to the same basket of goods. Shadow stats is actually the static basket of goods since 1982. And it is far, far higher in implied inflation than the current inflation rate. If you keep mixing up the bag, for the basis for comparison goes. I can compare my Ferrari of 10 years ago to your Ford Prius today, but there's a massive difference in the effort, speed, potential performance. So there's not an equivalent comparison. So there's a lot of deception. Some of it active, some of it passive by definition. Then let's go to the stock market. So we get this a little bit. We warned about melt-up callers and said there's no scope at the moment for new debt. Everybody thinks there's going to be a sudden burst of QE and new debt. And because of what I said about the bond market, which is why I start with that every time, the ability for the government to place new debt with happy-to-buy investors has gone. We crossed a Rubicon where everyone is looking at treasuries with a jaundiced eye nowadays. Since the events of 2020, which only really got recognized by most people in 2024, when Druckenmiller and Paul Tudor Jones started publicly talking about it. We are the news before the news. We gave this technically in the tail end of 2020. Those guys were behind us, but by the time they're telling you they'd got the trade on, so they were probably putting it on throughout 2024 themselves. So what you actually have is you have financial repression. You have Americans shorting America. So Druckenmiller, Paul Tudor Jones, a lot of people also like framing where they say the divorce crowd is doing this to me, or the Europeans caused, we had a eureka moment, rates spiked and the dollar crashed. Everyone has assumed milkshake theory, if rates go up, the dollar has a super spike. What you actually had was rates go up and the dollar go down. Why? Because capital was leaving America. They were selling treasuries, pushing the rates up, pushing the bonds down, and taking those dollars and moving them offshore. And everybody was then saying, well, it was the Japanese that did it to us, which is ironic because it's a financial slave of America since World War II. Others said it was Europe or the divorce crowd, etc. And it's actually found to be high net worth institutions, and Americans have been the biggest sellers of America. So this is what's going on. And there's a lot of misinformation and a lot of muddy up the water. So people are shorting America. Americans are shorting America. Paul Tudor Jones and Stanley Druckenmiller is an example of that. So they know. So these are some of the things people have to deal with. So with the stock market, if I just divide that by gold, it hasn't returned to where it was. If you look at what gold's done, that's the only true inflation measure that I can care for. Even if you divide it by the euro, which is another failed fiat that just does the dollar devaluation against a rival fiat, it hasn't, the stock market hasn't returned. And by the way, M2 is at all-time highs. So they've been pumping liquidity. And in actual fact, in real terms, the stock market is not there. So there's a lot, nominal is a hoax. And unless you rebase with inflationary measures. Nominal is a hoax the cultists want you to buy, in terms of the stock market's back where it was. Well, time has elapsed and gold has done far more than that. And in fact, now platinum has joined it, silver is perky, and a lot of other things that are all inflation-based indicators. So those are my riposte or my return response to the two items you mentioned there.
Sure. But anyway, the people will probably ask you, what is it that we need to look for? What is it? Where is it then we can go to say, if you can't trust what the Fed is saying, you can't trust the numbers that comes out in terms of the labor market, and also the stock market may be, in a completely blowing out of proportion here. What is it then that we could look for? What will be the key trigger of this debt crisis? Will it be sovereign debt, commercial real estate, derivatives? something else. Where do you see that fragility coming out? And also, you're touching on it, inflationary or deflationary. How do you see the effect of this? What is coming at us?
Yeah. So what's truth was one part of your question, and what people do with their money, not what they say, and represented by the most noble of money, which is gold. So gold represents truth to me, and it is screaming. A high gold price is voting lack of confidence. A no confidence vote in the fiat and debt system is an escalating gold price. And for those that say, well, you did 3.5 quite a few weeks ago, this is a beautiful setup. I'm preparing my community to trade this through the 3,700s. There's a few technical commentators that I've heard are now expecting it to be a localized high and it's going to pull back a long way. We're getting ready for more. This is a long trajectory and a long cycle of great sins that have been built up for 40 years, that the unwinding thereof is going to shock people by scale. And that's not for dramatic effect that I say it. This is a buildup of debt for so long that is so unmanageable. The United States actually has to eventually get, if it's to lose its hegemony, which I think is the eventual outcome, it eventually has to no longer spend twice what it gets in. It has to go beyond just spending what it gets in. It's got to go below spending what it gets in to pay kind of bankruptcy, severance, debt-based deals. It's almost like you do a voluntary, you don't go full bankrupt, you do a voluntary credit and you negotiate with creditors. There used to be a phrase for it, CVJ or CVC, depends what you're in a country. And what that actually means is you now live within your own means and you still make a payment to a collective that represents a reduced amount of debt once you've consolidated all the different creditors you owe. That's the quality of living standard that's going to hit Americans. You're going to go from a country that spends double to a country that not only can only spend what it gets in, but is actually for a while going to have a big ball of burden that's going to be some consolidated. Some of it's going to be partially reneged on and devalued through the dollar diminishment process, etc., etc. But you're going to be like a bankrupt that was living on a credit card at twice your income, and then suddenly all your credit cards are taken away, and you now have a monthly payment to make to them that represents a deal. And you're going to still have to feed, clothe, and do everything else. So you won't have any savings. That quality of living standard is going to be projected and placed on the citizens of America. And you're going to be told that it's your fault that this happened. You spent too much. You bought too many goods from China. You didn't don your torn jeans. You just bought another pair, all of this. So the governments of the world that have perpetuated this, particularly the US, by being the printer of last resort, is actually going to then condemn you for the situation they created. This is the inversion perversion. And the key point I was making when I was chatting with Bill Halter recently is that when times go bad and they start cutting on services, they renege on the social contract, welfare, Medicaid, they reduce it, they push retirement ages higher. All of these headlines are going to be coming, and it's going to be non-stop. It is going to feel doomer. And saying so isn't actually me being a doomer, it's me being honest about the future of when empires fiscally have failed. The coin clippers have destroyed this society in essence, by destroying sound money principles. So for Americans personally, if I were American, and I can only say if I were, because I've been in that situation, I would actually leave. I would go to places where there's innovation, an inflight of capital, lots more capital formation, exciting growth. And you can choose between the Middle East, which is maybe not that attractive to many at the moment. Dubai is about 43 degrees during the day, and other places. You can go to Indonesia, which is close to China. You can go to Singapore. Those are going to be that's where the capital formation is moving. And it's also where some of the technology is moving. And it's actually China that's taken a lot of leadership. You might not want to be too far from there. And that's what I see is actually coming for the world. And that's how I position. It's a very hard statement to say to America, your country's going to be that bad. But I had to do that in South Africa myself and recognize I'm at the wrong color skin at the wrong time. You know, I had an MBA, I was qualified, I wanted to work in trading rooms, and guess what? They were only hiring to make right for a previous apartheid, and I couldn't get work. I had to leave to get work, and actually flourished for doing that. You can actually get better off, and you can visit your country as a tourist, which is probably better because you're going to get better tax rates and a whole bunch of things. So I've said quite a bit, and I'll hand back to you to unpack where you want.
Yeah, sure. But again, so I understand that one of the indications of that things are now failing is the rising price in gold. But what will be the trigger of this price? Because people will then say, yeah, but it's, so many doomers out there have been talking about a coming crisis for such a long time, and we just haven't seen it. So where do you think we need to look in terms of where are the cracks coming? Where are the cracks opening up right now as we see it?
So first of all, ref the gold is moving, and our next move up, we think, takes us through 3,750. Short in the not too distant future, I'm talking within weeks that break starts, and within maybe a month or two that will be made. So you will look at something that was $1,600 at its low a couple of years ago that's now approaching $4,000 and is market cap. So I would say gold has and is correctly signaling that. Other places to watch for timing the crisis and real cracks is the USD JPY as a FX pair, and of course the debt market, so the 10-year and the 30-year US 10 and US 30. I'm also watching the Japanese US 10 and 30-year, and it was over 2 years ago I was being told by my team, your Japanese videos on debt in Japan are the lowest ranking videos, stop doing them. And I said, I'm not stopping doing them because people need to hear what I'm saying there, and it'll be as a social point that once again we were first to make calls on a collapsing debt market in Japan, which suddenly got everybody's respect recently, and then X was all about people that had newly discovered the Japanese debt markets, commenting on the 30-year. Our videos were out 2 years ago. We had setups, we called targets, and they've all happened. And now it's got so bad they needed to rein that in. And that's why we've been short both the dollar and the yen at the moment, and we've been long the Swiss franc as a part of our debasement trade. And I think the Swiss have a real problem because the Swiss National Bank cut to, I know you're not too far away, I think Denmark, Austria, that's probably far away for you, but the SMB set theirs to naught, and I actually see a set. I'll give you a prediction that I've only made once before live. I see the SNB bringing in a negative interest rate for foreign depositors at minimum to keep flight capital out of their country and currency. So there's a thought for you. Watch its move, because they are going to have a major problem. I'm a big gold fan. I say put it all in gold, but we still need utility of currency.
Correct.
And the best of the currencies is probably the franc. Some would put a case for the Singapore dollar and one or two maybe others, but there's not many. But you need to keep some cash in digits. And if you're like me, I have multi-currency accounts and it's all sitting in francs. That's money that I need to keep fairly liquid. The rest is all in gold, which is reasonably liquid, but you still have to return it to the vault or get it scanned if you've taken it out the vault before you can turn it into money. So we all have to have the utility currency. That's turning out to be the franc as the favorite for anyone at the moment. And we're doing very well trading that. We're getting, we're growing our P&Ls and we're turning that into more gold, more platinum and silver. So that's how we're going.
And how then do you see the whole crypto market in that respect? Because then that's where people maybe much unlike yourself would say, well, that's why you have Bitcoin. That's why you have the whole crypto world now appearing, and the most strength of at least Bitcoin at this point. So how do you see that whole setup here? What will happen to Bitcoin in the end game that we talk about here?
Short term, I'm bullish Bitcoin. So I'm going to be doing a crypto sniper video. I'm actually a bit late on it, but we've had a lot of travel and we've got the non-farm payrolls trading day coming tomorrow. So it'll probably only be out next week. But in actual fact, I see Bitcoin going probably decent chance to the 145, just sub 150 range, possibly getting a technical break of 150 as a short, medium-term call for Bitcoin. So technically, in terms of how it's set up, I have two separate technical patterns, in fact, possibly three. that all are giving me a cluster in the 145, 147, which points to a 150K possible run. So I think
Amazing.
Bitcoin will go
I got the
up.
same. I got the same there. So it's good to hear
Yeah.
that you have it as well, Francis.
Yeah,
That
so
makes
we're
it.
bullish it, but you do
Yeah.
know that my overall feeling is digital
Please share
scarcity
it.
is not the same as physical scarcity, and I put a big trench between the two. Call
Yeah.
it a gold mine's hole of 2 miles deep, all the way from
Yeah.
South Africa between the two. But nonetheless, for now, as long as people keep telling you it's real, it's going to be real and it's going to go up. So I am an active trader of that long, and on the certain alts side, we see them playing a major role in a CBDC type based solution that's going to be brought to us after a very chronic problem and a very severe reaction. That will be the
Right.
solution that they are very close to rolling out and can probably consider themselves ready just in time for all the repo markets and all the other things that are creaking in this controlled demolition that we're about to witness.
Yeah. I think it's interesting that we got the same target for Bitcoin, and actually also seeing the same that if you look at the Bitcoin gold ratio, it seems very bullish at this point actually. So I think you see Bitcoin will outperform gold at this point here. But actually also that, to me at least, the structure suggests that there will be a top at some point where Bitcoin will top out versus gold will top out. So that ratio will top out, and you're probably going to see that it's a major top actually. So that you see gold in the longer time frame going into the next, let's say, 5 years, you can actually see gold outperforming. That is not something that Bitcoiners would like to hear, but I think that's also in my perspective as I see it. But I wanted to go back to what you talk about, with with the U.S. and all, and also the reserve currency status of the dollar. So what do you see happening there then? Is this the shift then towards a multipolar currency system? Because as you say, we still need currency. We need to be able to interact, transactional wise on a daily basis, or what do you see coming there? And what kind of world are we looking into? Will it be ones which the BRICS is controlling the monetary system? Will it be one where CBDCs are controlling, or how do you see that?
I think you'll go multipolar. There isn't going to be one complete champion, but the notion everyone said everything is still dollar and it's all too dominant. It is like that for now. But slowly, for example, Iran and China on oil, that's all happening in yuan and renminbi. Russia's trade with China. In fact, you had Putin recently say 300 billion actually might be a reasonable price to pay for the development of the secondary system that they've built for BRICS nations, which won't steal another nation's country. You're supposed to be agnostic by payment mechanism and rails. That was a huge moment when the Biden regime chose to steal 300 billion. The money is actually relatively small, and I kind of agree with Putin. He had his perfect excuse to go ahead and implement his own system with China for that. So that's another major shoe drop moment, which will point to the fact that American financial systems are not being treated in the same way as they once were. A jaundiced eye on debt, an accumulation of gold, and a jaundiced eye on payment gateways that have Pax Americana stroke Western world vibes that have not adhered to being agnostic. So I think all of these are big nails into the coffin of the hegemony. And it's intended. It's a controlled demolition. Unfortunately, we are watching, like Europeans that I was, 9/11 again, but we're watching the financial equivalent of it. And that's where we are. Indices wise, I see there's a question. Someone was asking about indices. We've spoken about Singapore's indices. We actually have spoken about individual, those that want to get into military industrial complex. We have drone company setups. These are real hold your nose buys, but excellent setups with massive targets in China that can be traded in other parts of the world. So there's going to be a ton of opportunity. This doesn't mean everything down. A, you can short and make money in collapsing markets, but B, a lot of things have to go up when money escapes America. If you look at the market caps of all the stock markets, you have America at 63%. Then the next highest is at around 18% of developed market Europe.
Right.
And then you have China at about 17%. That Manhattan that is dwarfingly big over all these other little stumpies is going to
Yeah.
drain away into more of the others, and you're going to have a more spread, much less isolationist. Literally, the system has been Japan produces cheap financing. And that is a conveyor belt that goes like this, two rollers and the money. You get cheap borrowing loans in yen. You go and put it into the casino America. You trade mag stocks or you have treasuries, and you make the difference between the yield on the Japanese and the American yield. That's how it was. And then Europe and others jumped in. Even the Swiss National Bank itself bought Mag 7 stocks, one a very big holder, et cetera, et cetera. And America was the exclusive unicorn environment for equity investment. You're going to watch that dissipate and more mega players coming out of other countries. And you're going to watch that market cap dissipate. And all the talks about, but look at the stock market at new high, even at nominal terms, not obviously on rebased terms, that kind of chatter will dwindle. You're going to have higher taxes on corporates. You're going to have higher taxes on everything because you will no longer have the debt funding machine, the credit cards being pulled to have, with a bottomless overdraft to draw on. To meet the liabilities, and you've got an aging demographic in America. These are all the reasons why it's going to get bad, and you can choose to sit it out there because you were born there, or you can choose to do like I do and go. Sometimes you can be brilliant and never really manifest because you're in the wrong environment and it's very depressional and no one will lend a dime to anybody, and sometimes you need to get started or credit. You need clients with money who can buy. Why not be average execution, work reasonably hard, just keep showing up and go to an environment which is in a growth phase? So the environment, everybody talks about individuals. You have to be in the right environment to succeed as well. Elon Musk wouldn't have been succeeding in the Bolshevik Revolution or during Yeltsin's era at all. You wouldn't be running anything. Everything was being stolen. Sometimes the best entrepreneurs are also a function of the ability to operate and the support systems for operating and the environment for early, easy clients. So that's what I would say to people if I was in my 20s or 30s and watching this. You are nimble and young enough. You don't have to ride the downdraft because this is going to be a greasy pole for America. And by the way, a lot of talent, entrepreneurs, and capital is going to leave, and you're going to start to feel like you're in a bit of a ghost town. And there was a famous single done by the Specials called Ghost Town in the UK in the post-war era. It was 70s, 80s, showing, all the shops closed, boarded up, lots of things, driving at night, no one out at night, et cetera, et cetera. And it was called a ghost town. Unfortunately, the loss of empire and austerity that goes with that and high taxation is a very pessimistic, downer vibe. You can choose if you want to live that or you want to manifest elsewhere and go visit your home as a tourist, a wealthy tourist relative to your peers. That's up to you. By the way, when you have that environment, like I said, governments blame you. They don't blame themselves. Central banks and governments blame you. They turn more totalitarian in exerting, we need more tax to pay for that. It's time you did your bit. So they really, really ring. They squeeze the lemon till the pips squeak, basically, as they used to say in the UK. And you're going to be on the receiving end of that and told how it's all your fault. You overconsume, now you've got to pay the piper, da-da-da-da-da-da. America didn't succeed here. You lost a lot of wars. It cost a bunch of money. You've got to pay for it. You see, but they lied to you. Every time they go to battle, they're actually sending you an invoice for 10, 15 grand if you're a taxpayer. And they say, you can pay off on terms, then it'll be 20 grand and you can pay us a certain amount a month. Actually, they don't do that. The way they effectively do that is they put it on debt. It turns into inflation and it taxes your cost of living. You end up paying that by net effect. It's almost more honest. But if they phoned you up and said, we're thinking of this war, here's a 15 grand invoice, you can go terms and pay 20 grand, but spread over 36 months, or you can do this. How many people would be voting for that war in America? Not very many. But if they can put it on a debt bill and say, paid for the future, and eventually get this crunch point that you're getting, all your bills coming due all at once. Don't be a citizen somewhere else. Your forefathers ruined your country.
A lot of bad decisions made over a lot of years, and that ends up in this what is the big debt cycle top. As I completely agree with you, and you've just been talking about this and expressing it much more precisely than I probably capable of. But so the only place where I think I'm diverging a bit from you, because I also see this big yeah, end game coming, definitely. But I think there is the short-term deflationary part of it, which will be the part where, when the stock market is finally hitting a top here, which I don't think is too far out in the future here, probably not here in the summer, but later this year. Then I think the first initial impact will be deflationary, and I think it'll be the actual reaction from the Fed, thinking they can manifest orchestra a new free lunch kind of things with free money coming out, a QE kind of thing, that will actually push us over the edge. But I think you may be more we go straight into a more inflationary world here, and that's what you already see.
Now, there's scope for disinflation. So let's answer that, because and I think Lacey Hunt said it very well. Initially, tariffs is inflationary. Long term. So if you're a country USA, business USA, and you put tariffs up. So for example, BYD actually won the battery wars, not Tesla, for cars and vehicles. But you don't see any in America. You won't know that. But they're biggest power, longest lasting, generally superior product, in my opinion, and many industry makers. But you can't get them in America. You'd get a better vehicle for $30,000 from China than you could get from Ford for $45,000. But Ford and GM would go bankrupt, and they've had to make all this capital, and they would have to retrench and close a lot of jobs, and people would get very angry. So that's why BYD battery-driven cars are 100% tax, and I think they might have even put another 50% on that. So actually, if that's the case, that 30 grand vehicle in the US will cost 75 grand. So what happens is people don't buy it. And then they buy the Ford and GM version, which is an inferior product, for 45 or 50, when they could have had, if there was zero tariffs, 30, and a better vehicle, better product. So what tends to happen with tariffs is initially, people that absolutely have to have a foreign import for their mix, short term, have to buy it and have to pay the new price. In some instances, you've had Japan want to retain market share because Toyota is such a big brand in the States that they've absorbed some of the tariffs in their own margins. But long run, they can't do that. They won't trade improfitably. They hope that it goes away. They can bite their bottom lip, dip into their overdraft a bit, and retain market share. Because once you get people not coming into your dealership, that's a far bigger problem. So they wanted to maintain market share initially. So some people are getting away with still getting the same price on their Toyotas. So you will have some inflation on some products. You might have the Toyota experience where it stays broadly the same, but that company's making less profit. But they're taking a view that's got to turn at some point. Either the tariffs go away, or they end up having to push prices and slowly become more expensive, and then they will lose market share. And then in the longer term, you'll find alternative solutions that are domestic. And what that sees is less globalized trade, more renationalization, and also less consumption and less efficiencies. Right. So you buy lesser products with lesser relative advantage to be scaled and made to a high standard, and you end up with a lesser product actually inefficiently, quite expensively priced, because you have US labor costs, et cetera, instead of, say, the Philippines or somewhere else. So your cost of living goes down. So generally, globalized trade and the trend of globalization, which we had when we had the inflation miracle, there's no inflation, Greenspan said, was during the golden era. You now have, that was globalization. Everyone was moving workshops offshore, etc. Now we're having the inverse of that. So it's not doomer to say you get all the old stuff back and you lose all the benefits you got when you did the good stuff. It's a bit like, hey, there's a hangover after drinking 20 beers in a row or a bottle of scotch. It just is what it is. So that's the fact, and that's when people's living standards go down. They have less disposable income. Prices are stubbornly high, typically referred to as stagflationary environment, and your cost of living goes down, and you have something that resembles the 70s, where the stock market was largely flat with a lot of downside spills, never progressed, for those that are interested in the stock market in the US, only far larger and bigger. So I'm using the 70s as an association, but I'm not saying it's the same, because this is a much bigger scale to dry out. If you're losing hegemony, you're on the tallest ladder. Sure, Britain is as badly run, maybe even worse in some of the decision that's made. Sure, China has had a property bubble and a lot of debt hanging around, but they're standing on 3-rung ladders and 8-rung ladders. The hegemon is on the 26th ladder. He's 3 stories off, and all the ladders are being blown over. You fall hardest and furthest when you're the hegemon. And that's what most people don't get. Why is it worse for America? Because a lot of the cope that I see when I give this message is, well, what about them? And they're ugly too, and da-da-da-da-da, this kind of thing. As if it's like a contest. It's not. You're the hegemon. Who are the hegemon? China's not the hegemon. It might be one future larger player in a multipolar world, and one day may even become a hegemon entirely on its own. I don't know. You don't know. We can all guess. But the fact is, the United Kingdom is going to have a terrible downdraft. But they've already lost the pound as the hegemon currency. They lost, they're not, the gilt markets are not near the size of the treasury markets. So they will fall too, and they will fall badly. But they're not falling from as high as you, even though they're getting even more things wrong at every level politically, and they're chasing their millionaires away, and they're taxing more, and they're going full-blown socialism. It's a destructive policy times two. The fact is, though, they're doing it from a 3-rung ladder, not a 26-rung ladder. So they're going to fall hard, but they're going to fall hard from a fixed height. That's a meter and a half above the ground. You're falling out of a 4-story building in America. That's the problem.
Okay. Yeah, sure. All right. I'm sure I'm speaking for a lot of our listeners here that will say that I could, keep on listening to this for a very long time, but we also have a time constraint. So let's move on to, and I just want to ask the final question. I can see that is something that is also here in the questions. So how are you now positioning in light of all of this that we see and hear, and also with the stock market that's been keep pushing higher? How are you positioning now? Is it something that is changing here right now, or have you and what are you looking to how to look to position in the future? And after that, I think we should go to some of the questions and then see how far we can go.
So I'll refer to the stock market as probably, apart from individual equities that are giving brilliant setups that I like, as less interesting to me and not of my greatest focus. The reason is there's positives, there's tailwinds and headwinds on the stock market. You don't have an overriding assured trend, apart from at some point I expect a very disinflationary environment, which will see the stock market collapse. But in the meantime, you actually have probably higher inflation than most people will realize, and a dollar that's lost 10%. So just to stand still, the stock market should be going up 10% on the dollar basis alone, and then the inflationary basis. So you could do 15% this year in the stock market and you've gone nowhere. But during that period, gold's done 68%, silver's done 105, and platinum's done 150 for the year. That's where the action is. So I trade the predominant theme because it's long and it's continuous and it trends for ages, and it will give me lots of short-term setups along the way where I can really stretch a little bit on the leverage to be a bit naughty. And that's what I do. So if you're asking me what are my trades on, I'm doing famously with the Swiss franc long at the expense of the dollar and its funding mechanism, the yen. I am pointing out, however, that the yen is in what we call an M head and shoulders, so 2 small shoulders and a big M head. And if that breaks the 141 level, I will close the Swiss yen and I will just be Swiss USD, or I'll even go USD Japanese yen shorting the dollar. So that could be the big carry trade unwind, and that's one thing that I suggest that everybody keeps an eye on. You don't want to see the 141 range fall on the USD JPY. There'll be a chronic potential reversal because it's got real technical structure, and I think it will. But I think we'll get away with the yen being kept weak as a cheap funding mechanism to keep all the balls juggling in America. So don't trade the stock market where there's both, it's buffeting. And certainly at an index level, if you've got a real great setup on an individual stock, go ahead and shoot your lights out. We have quite a few of those. But at the indices level, there's no particularly interesting setup on the US stock market. There is in Singapore. We've spoken about it at length, big time frames, and we think that's going to do incredibly well. And it's going to be one of the beneficiaries of capital formation as New York and LA sort of time starts to lose its credibility. I would prefer people to focus on I still think the precious metals is the place to be of interest. And as I've mentioned, the currency markets. So as I say, strong bias on franc. We have real setups, and we've chosen the yen, as I've mentioned, and then we're long gold. We've got a tiny bit of silver. We expect there's a big move coming shortly with this payrolls number. It wouldn't shock me that even though we've had a weak period of dollar, that we actually get something out of NFP, which is a shocker, which causes a lot of disinflation, because they need an excuse to let the rates go down, and also to have a real drop in the dollar, to really let out. I talk about this geyser that has so much pressure in it, and there's a flame underneath it that's going to make it explode. And you have the two taps of the currency and the debt market. You actually need a bit more flow into the debt market, and you have to scare people into it. That means they have to scare people out of the stock market, and they also need the dollar to drop a bit more. So that's how they can drop the pressure in this essential blow-up situation. And I think maybe this payroll number, which is tomorrow, could maybe be a shocker, and maybe it'll almost be honest, and won't need a downside revision like all the others. Who knows? We'll see it. But it's a lagging indicator. We're seeing the big techs are firing people. The housing is in a glut. There's so many selling. We're deep and have been deep in a recession. I think we've dipped in and out more than once. The fact that they don't want to acknowledge it is the fact that they tell lies. They've suddenly associated employment as part of the issue. It used to be 2 negative quarters of growth. We already met that criteria in 22, or was it 23? So I think we've dipped in and out of recession, but they seem to get worse. So we're already pretty tough times, and it needs to have that lurch worse before they start admitting to it. So a bad unemployment number tomorrow could be a trigger for that, and that'll drop the dollar immensely, because that'll be, okay, now we really have to try consider rate cuts. They don't really have the means to do that, because, as I remind you, somebody has to be a buyer. So unless they flush a lot of US assets out of the stock market in a fear trade to go chase bonds, the problem they now have is not all of it will go to bonds like it used to. A much bigger amount is being hived off into gold, and even to some degree Bitcoin too. So what you could see is a very weak dollar. We're very bullish, risk on, in terms of gold and Bitcoin going into this non-farm. So I'm having a suspicion that whatever happens might be a breakout to the upside for Bitcoin, gold, silver, and platinum. And that's probably dollar weakness, which is probably a bad number.
Right. Okay. Thank you. You can also see the questions here. Any of these that you want to dive into? Any that you...
Let me have a quick scan. So I think I answered James Freeman's question, Singapore index. There's also potential on Bovespa. And there's one other that I can't recall. So that's particularly exciting that we've been looking at. Didn't hear anything about deflationary period. We've kind of did touch on that now. A financial market collapse is just deflationary. It's not just about tariffs and things like that. So yes, so when debt gets paid off or gets written off, you actually have a loss of currency. So what actually happens is money is dying. Money that got borrowed into existence is dying. So everybody is desperately looking for cash. Prices collapse, and that's what he's referring to. And it's not just about tariffs. I just mentioned tariffs because that was the narrative or the theme Trump brought to the table. But in fact, this is going to happen regardless of tariffs or not. And tariffs is just things people that are very indebted do to try stop running a deficit with Europe and China, which is exactly what's happening in America right now. And that's also one of the reasons they did the international terrorism of blowing up the pipeline. They need to sell their energy to Europe to help reduce that trade deficit, rather than have Russia do it. And that's part of the Russia-Ukrainian war. They've got to put that divide between Russia and Europe. Russia and Europe being happy and cooperating together would be devastating for America's trade deficit as well. Europeans would be getting cheaper energy, cheaper gas, cheaper oil, wouldn't have to go from halfway across the globe all the way, and would be paying less. And who's suffering for that? The British, the French, the German citizens are all suffering for it, and the automakers, which are now can't compete because their manufacturing is bad. So there's a couple of things. So that question is right about disinflation. Money dies when debt gets paid off or written off. So suddenly you have a shrinkage. It's a violent shrinkage. and that is a disinflationary event. And the governments don't like that. And they typically quickly try to remedy it because tax is their inflation on you, and inflation is their tax on you. So they would need inflation because they survive on that and they devalue their debt. They don't need their debt going up in value. But I don't think you're going to get the run into the bond market you used to for the things I stated right at the beginning of this talk. I think what happens is the alternative reserve assets have now become too big and too noticed by the jaundiced eye brigade, and as a result, people will buy gold. But gold and silver and platinum, particularly silver and platinum, will sell off on a disinflationary event.
Okay, that aligns us a lot. I'll say. I mean, I think that that sell-off I can definitely also see in a deflationary part of the crash first, and as you say, also there will be a quick response to that because nobody likes deflation. Any other questions here you'd like to dive into?
Turkey's stock market is booming as well, besides the currency inflation out of gold. You both see the scenario playing out now. Unleveraging would not support this thesis. As long as liquidity has an access, often if you rebase in real terms, those booms in Venezuela and Turkey don't look near as good. Sometimes they can actually be stagnation. Because the fact that you don't have a stable environment is a risk premium in of itself. So people demand a much higher return to play in something where the monkey's climbing so fast up the pole, but the pole is so greased that he's just about getting some ground. They'd rather not play that game. So generally the notions that those are the best markets, when you rebase them, often aren't the case. And they need a risk premium. However, if something's been properly slammed and you can go buy, say, a fruit and veg company that supplies all the supermarkets in Bogota in Venezuela, and the company's at a 1.8 PE because of the peso. That's a great purchase. It's a great purchase. So at some point, everything becomes a buy, and that becomes a real asset. And Turkey may have some of the same. So I think we're going to have much more of that Turkey-Venezuela vibes in America coming about. But you can't have the inflation rate get too high because you won't be able to stand the interest rates, and that's when the interest rates will go up. But I don't think you can assume the milkshake automatically happens necessarily, because there could be a lot of flight capital out. So the dollar can also devalue on increasing rates, not only climb. And that's the thesis of milkshakers, that it's only going to spike.
All right, let's have one more question. I think there's something about it says here, July has been a bullish month for crypto in regards to seasonality. Would you guys think that this holds true for July 25? Or we see a brief run to new all-time highs, then head lower. We have a CME gap on BTC at 93. So what do you see into the summer here? And do we have a summer doldrum? Will we have, will markets just come get you?
On seasonalities as well. You've got to be a tiny bit careful on seasonalities that are on the short-term seasonalities, like a month in a year. You can gather a lot of stats that will show July's, for example, being a good one. I think that's the comment the questioner is making. But when you have it coinciding with much bigger, longer seasonality cycles, the small ones get destroyed. And it's difficult to detect their influence. And kind of what I'm saying to you is there's much bigger. So you're getting all these little half semicircles that are months in a year. This one's a good one. And then you get this massive arc. And you've got to take it in there's complexities with seasonalities. In terms of, if you're looking at a monthly cycle, you also have to ask, where are we in the credit cycle? And I'm saying to you, the 40-year credit cycle is over. Which wave is going to hit you is going to be big. The monthly good little ripple, or the tsunami over there. So don't focus on the needles, don't focus on the one straw when I'm giving you a haystack. Get the big decisions and the big time frames right, and you just end up a lot luckier trader. You spend much less time trading against the macro flow, and this is an accelerating trend. This is why, as I say, platinum is now joining gold with a major surge. We have huge numbers coming out for that. Silver is looking like it's going to break. This is all short term ahead. This is all pointing to me the ongoing trend is debasement. The problem with the dollar, and they've already allowed for 3 years the debt to go down. We lost 52% on TLT, just like that, smash. Done. You literally took back a decade and a half of growth right there. There was escalator up and elevator down. So now that's the currency's turn. And this is going to play for a bit. And too many people are going to call time on it because they don't recognize this is one of the big arching macro cycles. You're talking about an end of a credit system.
Right.
And it's so scaled and it's so interconnected, it's bigger than any time before. It's a bigger fall than the Roman Empire's financial system because it's far more connected, there's far more citizens, it's far more real time, the ripple goes instantly around the world. You're not waiting for some wooden galley to tell you that there was a major plague in Europe if you're living in China. Or Marco Polo and his camel to get there with the news. This is instantaneous. So the shockwave will be felt pretty much the same day in most things when you have that name drop moment, the Lehman's of 2008, the lockdown of March 2020, along with that. We haven't had it yet. And when that happens, I do expect a disinflationary moment, but then I expect almost immediately the gold to turn and run, and in due course, silver and the other precious metals to run. So gold is just a stay on buy. People are going to sell too soon. And I think Bitcoin is going to get some. Bitcoin, I'm more cautious. I look at it the more short, medium term. I avoid long terms because I don't know if it still exists long term. It may be brilliant. It may be the reserve asset. You may get taxed on it. Who knows what they'll do with it? It's more. I don't know. It's 13 years, 14 years it's been around. I know that gold's still around. And I think at this time you need certainty. You just have to stay in the game and not get destroyed. Don't try hit a home run. You just bunt and get to first base and you're a winner because everyone else is swinging and missing. They don't have gold. The total holding, everyone will say gold is a bubble. Less than 1% of hedge funds. I've researched this. Noughts. One hedge fund at 2%, a handful at 1%, some have 0.5 and some have none. Major family offices, they're all at that level. So you're in a number between 0 and 2%. It's talking like building insurance. Imagine I only was insuring 2% of my house or my building. You just wouldn't do it. This is insurance for an assured mathematical collapse. I'm telling you, I use the Inception, the movie, and I've got to keep this short because I know you're at your time end. The car's already smashed over the bridge. You all remember the scene. They're dropping the time frame. It's not if you're hitting the water anymore. You're off the bridge and you're in there, and it's tipping like that. And the guys have dropped down time zones. They're going level, and every second is a year in the lower level and lower level. They've got to try to fix this thing. But the car hits the water. That's physics and gravity.
Yeah, it's physics.
It's not a negotiated
I like that analogy.
Yeah, so I mean, we're hitting the wall. America is hitting the wall. It's a fact. There's nothing they can do. They put in Jesus as president. He can't fix that. You can't get the growth. You can't roll back that debt. You can't meet those payments. You won't be able to get people to vote for cutbacks in Medicare and welfare. It's not happening. It doesn't matter. The car's left the bridge. So the water is going to be hit, and you still have a chance to insure it. So it's kind of like, would you like to insure this car about going off a bridge and hitting the water? And there's the Inception scene, with the bits of concrete in the car already tipping down and everybody bouncing in their seat. Go watch the movie if you've forgotten it. And I'm like, if you're getting, and I'm still selling policies to you, do you want to insure it for 5%? Or do you want to insure it for 250% and get a better car? I don't know. It's up to you. I know what I'm doing. I'm overweight. That's it.
Francis, thank you very much for coming on today. Thank you. It was great that we could catch up again. Last time was in South Africa. It was a great time, and enjoyed talking to you back then and again today. So thank you, and I hope we'll stay close in touch. And just to the crowd here, how can people learn more about you and your business and how to get in touch with you?
Yeah, we feel this is going to be immense opportunities in a bizarre way in a collapse, as there always are. In fact, the word of crisis in China is opportunity and crisis. It means the symbol means the same thing. It takes a more holistic view. In fact, I should use it as a backup branding because that's where we are. There is a crisis and there's immense opportunity. All you get is bad positioning. So we're here to help you position better, to make money, to preserve capital that you've already made and that you are now making, and to also secure your optionality in an environment where totalitarianism and more draconian governments are going to exist. That means scavenge mode for taxation, residencies and other aspects about keeping your wealth and your quality of lifestyle and freedom. So if those are three things that are of interest to you, go to the YouTube channel, The Market Sniper. We also run the crypto side of it, The Crypto Sniper, so all with the. And you'll be able to stay in touch with us there, and there's links there if you want to engage further.
Thank you so much again, Francis, and to everybody. This was the end of this session here. Make sure to tune in next time, where we again will sign up with or meet up with an interesting person just like Francis here, and have a great afternoon. Thank you.